As the software industry moves toward fragmented, API-driven microservices, mid-market businesses are facing a severe consequence: deep, impenetrable data silos. When supply chain, human resources, and sales operate on disconnected platforms, a reconciliation gap opens up. Operational data, the actual events on the factory or warehouse floor, fails to map natively to the financial reality recorded in the ledger. This is a month-end balance sheet generated by a perfectly integrated system. Assets and liabilities balance automatically, producing a document requiring zero manual reconciliation. Generic software suites routinely fail to reach this state. If a university budget request or a shop floor yield report does not directly update the general ledger, the architecture is broken. Consistent operational visibility requires a monolithic, tightly integrated architecture built on a rigid relational database. We're going to deconstruct the ASP.NET and SQL Server architecture of specialized vertical ERPs to see exactly how daily operational workflows synthesize into financial truth. Achieving this level of financial accuracy is a structural architecture requirement, not merely an accounting challenge. This is the N-tier application architecture. It serves as the structural foundation of the zero reconciliation ERP, divided into three distinct layers. At the top is the presentation layer. Built on web forms, this acts as the entry point for highly specific vertical workflows, where raw data enters the system from users on the floor. Below that is the business logic layer, or BLL. Here, data is processed through C# logic gates, ensuring that every operational action, whether it is a stock transfer or a payroll run, follows the institution's specific financial rules. Finally, the data access layer utilizes ADO.NET and Microsoft SQL Server. This layer provides the ACID-compliant transaction safety that locks data into structured, relational tables. Loose API integrations across fragmented SaaS products struggle to maintain this level of data integrity when processing high-volume ledger transactions. Data is frequently dropped or delayed during transfer between disparate systems. In this monolithic architecture, the SQL database is the final arbiter. Its table constraints and relationships dictate exactly how the business is permitted to operate. To reach a zero reconciliation state, the system must employ an automated double-entry engine. This mechanism replaces manual month-end batch uploads entirely. Consider this operational trigger: the submission of a goods received note, or GRN, on the warehouse floor. The moment the GRN is submitted, the transaction splits into two distinct pathways. First, a debit packet increases the inventory asset account. Simultaneously, a credit packet hits accounts payable. If the purchase involves tax liabilities, such as VAT, those calculations are executed and posted to their respective ledgers within this same autonomous transaction. This process occurs in real time, removing the need for manual data entry within the finance department. Zero reconciliation is achieved because human transcription, the primary source of discrepancies, is engineered out of the process. This architecture is specifically required for extreme vertical complexity, such as the XERP platform's approach to import manufacturing. In international trade, calculating true landed cost is a major logistical challenge. Generic purchase orders simply cannot handle the variables involved. This letter of credit workflow tracks the entire process. A central node absorbs inputs from multiple stakeholders, capturing freight, duty, and agent fees. Upon receipt, the system capitalizes these disjointed fees directly into the final inventory cost. Generic ERPs force businesses to extract these complex letter of credit processes into separate spreadsheets, which leads to delayed and often inaccurate costing. Generic software attempts to abstract complexity, while vertical monoliths metabolize industry-specific complexity directly into the ledger. Monolithic architectures actively enforce institutional policy by embedding it into the data entry process. This is highly visible in the administrative workflows of higher education. For a university, departmental budget overruns are a serious institutional risk. After-the-fact reporting fails to stop them because the money is already spent by the time finance reviews the data. This binary logic gate represents a budget control gate. A submitted purchase requisition queries the general ledger. If the remaining budget meter reads insufficient, the request is structurally blocked. Because the system is monolithic, if the funds are not there, the workflow halts across the entire software stack. The purchase order cannot be generated. A true enterprise system uses its architecture to enforce compliance at the point of origin, turning financial policy into unbreakable code. Once operational data is locked into the database, it must be extracted for strict government compliance. This is achieved without the use of heavy middleware. Platforms like ALZRP utilize SAP Crystal reports to query the SQL tables directly. This direct connection ensures no data manipulation occurs between the ledger and the final report. This querying outputs region-locked artifacts. On the left, a Phase 2 e-invoice for Saudi Arabia. On the right, a structured Musak that return for Bangladesh. Bridging the reporting tool directly to the raw SQL ledger guarantees that an organization's external tax submissions are an exact reflection of their internal operations. A monolithic ERP ties every micro-action, from a barcode scan to a machine efficiency log, directly to a hierarchical chart of accounts. For IT consultants and SaaS entrepreneurs, building this architecture from the ground up presents a significant business challenge. Architecting an N-tier, double-entry financial engine requires years of capital expenditure and carries significant liability if the transaction logic is flawed. The alternative strategy is acquiring a mature, commercial-grade codebase. This bypasses the foundational R&D phase entirely, providing a deployable module on day one. Owning the source code enables several commercial strategies, from on-premises enterprise installations to managed SaaS offerings or white-label consulting. Acquiring this code means instantly adopting battle-tested financial logic rather than spending years trying to write the strict rules of accounting into code. Owning a vertical-specific monolithic ERP shifts the focus from reinventing the rules of accounting to deploying a ready-to-use foundation in highly specialized markets.